Hello, my friend. Today we're going to talk about how to invest in the S&P 500 index through Robinhood. The S&P 500 index trades as an exchange-traded fund with the symbol SPY, and you can buy it just like you would buy a regular stock. So with Robinhood plus the SPY, you can invest in the S&P 500 index every month. Now, for those of you new to investing, we will go over step by step on how to do this. One of my subs suggested this would be, an ideal subject for a video, because he says that there are millions of people like him out there that don't know how to do this and wish to learn. And so he said that this video would be a great help. So here it is. I hope it translates to many views for me, for my channel and subs. So let's go. So I assume everybody has a Robinhood account, but if you don't have it, in this video there's a link in the description. You click on it, it takes you to the Robinhood site. You open the account, they'll give you a few shares of free stocks, and then you have to fund the account. You have to link your checking account to the Robinhood account. They'll walk you through how to do it. But after you have it set up, then you go to the app. It's in the this is my phone, so I'll just go to the Robinhood app. You see it right there. It's right next to YouTube, right there, this one. So I click on it. It has the little feather, right? So here it is. Then what you do is you would go to the in the bottom, it gives you the menu, right? You will go to the search, the one with the hourglass. So you would want to search there, and it says search companies right there on the top. So you put the symbol SPY, and there it is. You see it? So the first option is the Standard & Poor's 500 index. That's the ETF. So you click on it, and then it tells you how much it's selling for. Right now, at the close of Friday, today is Sunday. I'm putting this video up on a Sunday. It was selling on Friday at $422 per share. Now, you don't have to buy, you don't have to spend $400 to buy, because they offer fractional shares. That's the beauty of it. So you could buy a fraction of one share. It used to be that you had to spend, you had to buy lots of 100 shares, but not anymore. Now you can buy a fraction of one share. So you go here on the word trade, you click on it, click on trade, then it gives you various options. You put buy. That's the one you want to do. You want to buy. And so it gives you options. You could buy $1, you could buy $10, you could buy $100. Let's buy $1. You see right there? It's $1. So then it says there swipe. You swipe like that, and you're done. Your order is received. Obviously the market is closed today. It's Sunday, but when come Monday, it will be executed. You don't have to trade in business hours or when the market is open. You can put your trade now like that. So with $1 invested, it's 0.002366 shares. So you're done, and you hit here done right there, and that's it. You're done. Ideally, you should buy $100, $50, whatever you can afford every month. If you invest, for example, $170 every month, that would be about $2,000 a year. Over 50 years, that would be 2,000 times 50. That's $100,000 that you invested. Now, if you invest in a portfolio that returns 5% per year, guess how much this would be? Your $100,000 would grow to $453,000 at the end of 50 years if the annual return is 5% per year. But in the S&P 500 over the last 50 years, it has averaged 10%. So obviously some years were down, some years were up, but on average, the S&P 500 returned 10%. So at 10%, that's twice as much as 5%. The amount that the $100,000 grows is not going to be twice as much because of the compounding. It's exponential. It's actually going to be 2.9 million, almost 6 times as much. That's the beauty of compounding, and compounding over time. So the 10%, of course, was the historical return on the S&P 500. How likely is it that it's going to be repeated in the future? I think very likely, in my opinion, because it has been 10% for many years, many decades. You know, obviously it's not guaranteed. You don't have a legal guarantee, but there's a trend here. You know, the market goes up with the growth in the economy. And when you're buying the index, you're buying a cross section of the American economy. So obviously the index renews itself. So 30 years ago, the index had no technology companies except for IBM. But now Google, Microsoft, Apple, they all represent about 25% of the index, a quarter of the index. And they weren't there 30 years ago. So the index automatically incorporates the new fast-growing, fabulous companies that come up. So what's going to happen in the future? Nobody knows. But the certainty is that if you hold the index, you're going to hold the companies that are growing and that are doing very well. So obviously when you invest, there's risk and you can lose money. But if you hold it for a long time, it's very, very unlikely that you lose your $100,000. I mean, it's going to grow to $2, $3, $4 million, who knows, into the future if you hold it for 50 years. So there you have it. Hope you find this video useful. If you have any questions, you can comment on the video. Otherwise, I wish you the best, my friend. Be well.